Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Do explore the other funds covered in this series and subscribe to the channel if you find this video useful. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the Amova Singapore Dividend Equity Fund. This video is done as a follow-up request from a viewer's comment in my previous video covering the then Nikko AM Singapore STI ETF. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos and I'll be happy to work on it as long as I can find enough information on the product. Amova Asset Management is the rebranded name from what was previously known as Nikko Asset Management. The rebranding was done on 1st September 2025, although it took nearly a month for them to update all the relevant fund documents to the new branding, which I was waiting for before making this video, so that all the extracts included in this video are consistent. The company was formed in 1999 from the merger of Nikko Securities Investment Trust and Management and Nikko International Capital Management. I personally like Nikko Asset Management as a better identity for its origins, so I don't really understand why the rebranding needs to be done, but that's just me. The company was briefly acquired by Citigroup in 2007, who sold it to Sumitomo Trust and Banking in 2009. Post some mergers, the parent entity is now known as Sumitomo Mitsui Trust Group, a big conglomerate in Japan. Amova is a directly owned subsidiary. The then Nikko AM made several business acquisitions in the Asia region in 2011. One of them was the acquisition of DBS's asset management arm, and along with that, several funds including the Singapore Dividend Equity Fund covered in this video were taken over by Nikko AM. The fund family therefore changed from DBS Shenton Horizon Investment Funds to Nikko AM Shenton Horizon Investment Funds then. With the latest rebranding, this has been further simplified into Amova Investment Funds. While having a strong Japanese heritage, Amova brands itself as a global asset management firm and operates in 10 countries and regions globally, managing over $260 billion of AUM as of June 2025. Amova's product solutions outside of Japan onshore mainly revolve around Asia in both equity and fixed income aspects. There are efforts to produce more global solutions, but this is not easy, especially the number of competing fund providers and fund solutions have grown significantly over the years. The Amova Singapore Dividend Equity Fund is a sub-fund under the Amova Investment Funds fund family. As earlier mentioned, this was recently rebranded on 1st September 2025 from Nikko AM Shenton Horizon Investment Funds. Amova Investment Funds is set up as a Singapore umbrella unit trust structure and currently has 4 sub-funds within the fund family. The fund is registered as a MAS authorized scheme, which means it is suitable for retail investors. The Amova Singapore Dividend Equity Fund is co-managed by Lai Yu Huan and Kenneth Tang, as per stated in the fund prospectus. It is strange that Amova doesn't provide manager information in its fund fact sheets and web pages. Yu Huan is also the head of Asian equity in Amova and has over 25 years of experience in Singapore and ASEAN equity markets. Kenneth is a senior portfolio manager having similarly over 25 years of experience. Though besides Singapore equity coverage, he also brings about equity long-short and commodity research experience to the team. There is no information available on the analyst team supporting the managers. The Amova Singapore Dividend Equity Fund has a pretty interesting investment objective. There is only one objective stated, that is to achieve medium to long-term capital appreciation. This is interesting because for a fund name with the word dividend, We would normally expect it to have income generation as an objective, but not in this case. The fund has distributing share classes though, and we will explore the distribution information later. The intended objective is to be achieved by investing primarily in Singapore-listed stocks. There is flexibility to invest beyond that, and we will see in a while if there are any limitations stated in the prospectus. There is an additional requirement for the selected stocks to offer attractive and sustainable dividend payments, with potential for long-term capital appreciation. This is somewhat contradictory, as paying out dividends means the company is keeping less capital for future growth. Therefore, high-growth companies normally do not pay out much dividends, if any at all. This is also why the capital appreciation part here is stated as potential, meaning it is not mandatory. So the contradiction here is that the objective is trying to achieve capital appreciation, but the underlying positions are not focusing on stocks with high capital growth potential. This is quite weird, but let's explore further details in the prospectus. The investment details in the prospectus for the fund is quite short. It starts off stating the same objective again, that is only to achieve capital appreciation. This follows by a paragraph stating that the fund does not have a benchmark. Footnotes from the fund fact sheet further discloses that the benchmark was previously the Straits Times Index or STI, but was removed in November 2017. I tend to disagree with active funds on meeting a benchmark or returns target, because that means there is no way for investors to justify whether the fund is delivering a good or bad performance. If this fund is consistently underperforming the STI, would investors stick with this fund or switch to a STI ETF instead? Most probably the latter. So I don't really see any reason for an active fund to do without a benchmark, unless the manager has no confidence in his ability to outperform the market. The only limitation specified in the prospectus is that the fund needs to invest minimum 55% in direct stocks, which means it can have up to 45% in REITs, ETFs, and other mutual funds. There are no constraints specified for Singapore versus non-Singapore exposures, which is rather surprising. There is a short sentence at the end stating that the investment process is a mix of top-down and bottom-up analysis. Unfortunately, there are no further elaborations on this, so we don't really have more insight into things like whether top-down macro views impact sector exposures, or what are the specific financial matrices used to filter stocks in the bottom-up analysis. There are some descriptions on the broad investment process of the Singapore equity strategies that are not specific to the fund. These are mostly rather generic descriptions that do not really offer much more in-depth clarity. This follows by a section called People, Process, Portfolio that is a bit more useful, that states the funds are typically concentrated portfolios of 30 to 40 holdings. The part of active share isn't applicable for this fund, since it decided to remove its benchmark. Then finally, there are some contents specific to the Amova Singapore Dividend Equity Fund. It is mentioned that the holdings in the portfolio are categorized into dividend anchors and dividend growers. There is no further elaboration on this, though from the names we can deduce that dividend anchors are stocks with high and stable dividends, while dividend growers are stocks with low dividends but with potential to increase the dividends over time. There is finally a section talking about the usefulness of dividends in the Singapore equity market, and by reinvesting the dividends it helps to generate good returns. Emphasis here is that the dividends should be reinvested, not paid out. The Amova Singapore Dividend Equity Fund was incepted in 1999, so that gives the fund a pretty long 26 years of track record. The fund AUM is currently over 1.7 billion Sing dollars, which is a very decent size for a Singapore equity solution that wouldn't be popular for investors outside of Singapore. These are data obtained from the fund fact sheet, as the fund webpage strangely does not have them. Country allocation shows 86% in Singapore and about 6% in Hong Kong, Philippines, and Thailand. There is a pretty high 7.5% in cash equivalents that I hope is not the norm, as I think active mutual funds should be close to fully invested and have at most 5% in cash for liquidity purposes. Sector allocation shows the portfolio is quite well diversified with over 20% each in financials, real estate, and industrials. This is quite different from the construct of the Straits Times Index or STI, which is the most common index to represent Singapore equities by market cap. Amova has a passive ETF that tracks the STI, which I covered previously when it was still under the Nikko AM branding. So let's use it for comparison. We can see the significant differences between the two, whereby the Singapore Dividend Equity Fund has significantly less financials, while boosting up the allocations of most other sectors. Of particular interest to note is that consumer staples seems to be missing, or hidden in others, while there is an allocation in technology that is not appearing in STI. These differences should likely be the consequences of the investment strategy of looking for stocks with existing or potentially high dividends. The top 10 holdings reflect the significant differences as well. No longer bounded by market cap weighting, the Singapore Dividend Equity Fund has significantly lower allocations to the three local banks, and as well has other stocks appearing in the top 10 due to their higher dividend yields. With 43 holdings, the fund does have a more diversified portfolio than the STI ETF. So while it is good to see that there are definitely plenty of active management work being done to generate a rather different portfolio compared to the STI, the main question for investors is that, does this differentiated portfolio translate to a superior performance versus the STI? We will run some performance comparisons later. Morningstar provides some additional portfolio statistics for us to refer to. I wouldn't be too concerned with some of these data given the constraints of the Singapore equity market. For example, liquidity tends to be low as the trading volume of most Singapore stocks tend to be much lower compared to US and Europe markets. Something to note here is that the dividend yield of the underlying holdings in the portfolio is 4.67%, and as seen in the graph on the left, this is not on the excessively high side. So it suggests that a sizable part of the portfolio is not stocks with existing high dividends. The Amova Singapore Dividend Equity Fund comes available in Sing dollars and US dollars unhedged currency classes. For both currencies, they are also available with accumulation class and monthly distributing class. The distributing classes were incepted in 1999 at fund inception, while the accumulation classes were incepted later in 2022. The fund charges a 1.25% per annum management fee. Adding other expenses gives a total expense ratio or TER of around 1.45% per annum. Up to 60% of the management fee can be paid by Amova to distributors as trailer fees. This is broadly in line with other Singapore equity mutual funds and slightly cheaper than typical equity funds in the global market. The fund allows up to 5% subscription fees to be charged by distributors, although I think anything more than 2% for mutual funds is excessive. The Amova Singapore Dividend Equity Fund interestingly defines a distribution yield range in the prospectus. Although the fund will review and adjust this range periodically according to market conditions, similar to other mutual funds, it is rather uncommon for a fund to specify the target payout yield in the prospectus. At the moment, the target payout yield range is set at 5 to 7% per annum for both the Sing dollars and US dollar share classes. The distribution history is available by downloading a distribution summary Excel file from the fund webpage. The Excel file contains detailed distribution data for the past 1 year, which is useful to understand the distribution policy of the fund. We can see from the data table that the fund has been setting a distribution payout yield of 5.3% per annum for both the Sing dollar and US dollar share classes for the past year, and that the payout has been smoothened to deliver about the same payout yield every month. The fund obviously cannot obtain dividends every month, so there are months where the fund will need to take some capital to top up to the payout yield, as clearly indicated in the data table. For investors, the main concern would be whether there is enough capital left in the fund for long-term growth, as the fund's objective is capital appreciation, not providing attractive income payout. Here is the NAV versus total return chart of the Sing dollar class since inception. It seems that the distribution payout only started in 2012, so let's adjust the time period accordingly. With the adjusted chart, we can see quite clearly that the NAV appears to be kept within a range, which means that pretty much most, if not all, the return gains have been paid out as distributions over the years. So the distribution class basically serves as a vehicle to convert the gains into distributions, with no meaningful NAV growth potential to be expected. The US dollar class shows exactly the same as the Sing dollar class, again with the NAV kept within the range with no meaningful growth, and that all the gains are paid out as distributions over the years. Personally, I am not a fan of equity products with no capital growth, because this is not a bond investment where you are just looking to clip coupons and get back your original capital at the end of the day. Equity investments should be for long-term growth, and that growth gets compounded over time. Of course, this is on the assumption that you believe the product will do well. Otherwise, you might as well avoid the product altogether. Therefore, in this case, I would prefer the accumulation share class of the fund over the distribution share class. The Amova Singapore Dividend Equity Fund provides annualized performance data across various time periods, as well as 3-year Sharpe ratio and standard deviation in the fund fact sheet. The fund has no benchmark, so it is hard to tell if this is a good or bad performing fund simply with this data. As the US dollar class is currency unhedged, the performance tends to be slightly different from the Sing dollar class due to FX movements. The result is that the US dollar class has delivered slightly better returns over time, but comes with notably higher volatility. There is currently no US dollar hedge share class available for the fund, so US dollar investors looking at this fund do need to take note of these differences. Here is a comparison of the two currency classes since fund inception in 1999, showing the differences in long-term performance. It should be noted that the US dollar class doesn't always outperform the Sing dollar class. Looking at a shorter 5-year chart, we can see better that there are times when the US dollar class outperform as well as underperform, all dependent on the dynamic changes of the FX pair. So don't assume that the US dollar class will always generate higher returns. Now, without a benchmark, it is hard for investors to figure out if the fund has a good or bad performance. Fortunately, Amova has two other Singapore equity solutions for us to compare against. One is the Singapore STI Index ETF that is a passive index tracker, which is good as a non-active strategy comparison. While the other one is the Singapore Equity Fund, rebranded from the Nikko AM Shenton Thrift Fund, that is managed by the same two co-managers as well. The difference between the two active funds, as the names imply, is that one has a dividend focus in the stock selection strategy, while the other doesn't. So this will be good for us to see whether the dividend focused strategy is better or worse. The Singapore Equity Fund also looks to have a sector allocation that is roughly in between the Singapore Dividend Equity Fund and the STI ETF. Here is a comparison chart of the three products since 2009, as the STI ETF was incepted then. We can see that the Singapore Dividend Equity Fund has outperformed the other two most of the time, and the Singapore Equity Fund only overtook it in 2024. So from a long-term basis, the Singapore Dividend Equity Fund does look pretty decent. If we move to a more recent 5-year chart, things look quite different. We can see that the STI ETF has instead been taking the lead, while the two mutual funds performed nearly the same in 2021 to 2023. Singapore Equity Fund then significantly outperformed in 2024, leaving Singapore Dividend Equity Fund quite far behind. This shows that the dividend-focused strategy did not do well in 2024. Let's look at calendar year performance comparisons next. Here are the calendar year performances from Morningstar, with the best performer of each year outlined. From this data, we can see that there is no clear winner across the years, as each of the three products took turns to lead in different years. Comparing between the two active funds, the Singapore Equity Fund does look more promising than the Singapore Dividend Equity Fund, as it has generated more number of better yearly returns and also seems to do better than the STI ETF over time, suggesting that active strategy can work at times. It is also not restricted to a dividend-focused strategy, meaning it can adjust its portfolio more flexibly according to market conditions. In consideration of this, plus the performance and the sector allocation, I personally like the Singapore Equity Fund more than the Singapore Dividend Equity Fund. With that, let's summarize our findings. Amova Asset Management, previously known as Nikko Asset Management, is an established Japanese asset manager that is relatively small compared to popular global fund providers, but is decently recognized in Singapore and Asia. With over 1.7 billion Sing dollars of AUM, the Amova Singapore Dividend Equity Fund has been a popular fund in the Singapore market since its inception in 1999, originally under DBS Shenton Horizon branding, then under Nikko AM branding from 2011, and now Amova. The fund has a rather odd match of investment objective versus strategy. The objective is to achieve long-term capital growth, but the investment strategy has a focus on dividend play in both dividend anchors and dividend growers. The fund additionally pays out most, if not all, of its gains over time for the distribution share class, which currently translates to about 5.3% payout yield. This does not look consistent with the fund's objective for capital growth. Therefore, in order to best align to the fund's investment objective, investors should go with the accumulation share class instead. It is quite difficult to find details on the investment process, as there are some relevant information that are not even in the fund-specific webpage. The removal of the benchmark in 2017 is puzzling. No matter how the fund is positioned, it is still a Singapore equity fund, and therefore it should be designed to outperform a Singapore equity index, be it STI or something else. Without a benchmark, it is hard for investors to tell if the fund has a good or bad performance. Performance-wise, the fund did have decent performance in the earlier years, but has generally been weaker than STI in recent years from 2021 onwards. This suggests that dividend-focused strategy has not been that suitable for the market conditions in recent years. In conclusion, having a dividend-focused strategy limits the flexibility for the fund to do well in market conditions that do not favor such strategy. The good news for investors is that there is a similar fund called Amova Singapore Equity Fund that is run by the same managers and do not have such strategy limitations. Therefore, it seems to be a better pick than the Amova Singapore Dividend Equity Fund for long-term active play in Singapore equities. This concludes my absolutely biased comments on the Amova Singapore Dividend Equity Fund. Again, if you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.